But what's the way forward for the market? Krishna Kumar Karwa, the MD of Emkay Global, joins us now to talk about that. Mr. Karwa, good morning. Great to see you in on the show. It's been a good days for our markets. The month of May has been kind so far. But what's the sense that you've made of the earnings season so far? The assessment is that it's not been as bad as what we were expecting earlier. Is that the feeling you're getting as well?
Good morning. As far as the earnings season is concerned, there has been a mixed bag kind of results. So if you look at some of the PSU banks, they came out with numbers which were much better than expected, and we have also seen the stock prices of some of the PSU banks performing accordingly. So, and then you had the IT companies. IT companies, yes, the results were broadly in line with expectations, but maybe the stock prices had not reacted in advance, and then they reacted post the numbers, and now I think the IT stocks have also been at par. So there have been pockets like you have seen the FMCG companies also. So numbers have been reasonably in line with expectations, but the management have been very cautious about the way forward, and so again that's been the case. So I think broadly what you said, that the result season has been in track with the analyst expectations, and so stocks may have reacted based on the valuations at that point of time.
Good morning, Mr. Karwa, and thanks so much for joining in. I was reading a report where you say the context of widened gap between business cycle and market valuation will keep the market susceptible to negative triggers. Walk us through the negative triggers as you see it, because earnings has been mixed. It's not been worse than what the street was anticipating. And how much downside is there for the markets now?
See, as I said that sometimes what happens, the expectations have been ahead of the curve, and the valuations of the markets accordingly are ahead of what the ground level or the basic fundamentals are. So that's what we have tried to bring out in that research report, where we believe that markets have discounted the expected uptick in advance, and we believe that the turnaround in the economy per se would take longer than expected. Maybe it could be at least 4 to 6 quarters ahead of the curve. So that's where the disconnect is, and at the same time, having said that, we still believe that global liquidity being what it is, it's not going to be total capitulation as far as the markets are concerned. So there could be sectoral shifts which could happen, which means that you believe that maybe the IT, pharma, so defensives will continue to outperform, and the infrastructure, cap goods space, which have probably run up in anticipation, they may probably consolidate, and then as things on the ground level start improving, then they should be in a position to come back.
Okay. So what is the recommendation to investors at this juncture, Mr. Karwa? Is it still a market that one should be buying on every dip?
See, inherently we should believe, it depends on the horizon that the client investors have. As long as your horizon is long enough, then we are in the midst of an uptick, but in the immediate, probably it's more of a consolidation kind of a phase that we are going in, and it would be best to be on a bottoms up kind of an investing style rather than a macro style is what we are recommending.
Okay, so speaking about bottoms up, we've seen some good earnings in the likes of, a Britannia or a Voltas today. In the mid-cap space, which were the earnings that you liked? And, in the recent past, post the earnings, you have, changed your opinion on these stocks and recommended a buy.
Yeah, I think mid-cap investing is all about bottoms-up investing, and that's where it stands. As per regulations now, we are not supposed to speak about individual stocks. But one thought which comes to our mind is that many of the PSU banks, the valuations of many of them now are like mid-cap valuations. So probably from a longer-term perspective, the whole PSU banks look like a decent long-term investing opportunity. Apart from that, I believe that there are quite a few cement companies in the mid-market sector, where if you believe that on a 2-3 year horizon, if you are positive and the whole domestic economy and the infrastructure space, then quite a few of them offer reasonable valuations and decent operating cash flows from a 2-year perspective, which should be invested in. So these are some of the bottoms-up investing ideas that we believe can offer you good returns.
Okay, in fact, I wanted to come to you on, this news flow that we're getting on our screen, which is very important for many of these sectors that you spoke about. Our colleague Anshu tells us that the coal ministry is pushing for coal mines and the linkage auction next. Remember, after the success of the government's auction of coal mines, now there is a second set of reforms that could be underway, which would be the government auction of coal linkages, and this will be to meet the coal demands of many of these unregulated sectors like cement, iron, steel, etc. Two methodologies are being proposed. We'll talk about all of that in greater detail. But Mr. Karwa, comment on this. This government has made some concerted efforts towards solving the problems of coal supply, etc. What is your own view on how much of a positive this proposed auction of coal linkages could be, and the impact it could have on many of these unregulated sectors like cement, iron, steel, etc.?
The government at the last 12 months has been making concerted efforts to ease the whole resources issue, and this is again an extension of that process. So, obviously this is going to be beneficial to the companies in terms of availability of linkages, etc. But the question is, again, these auctions, earlier also we have seen some of the coal auctions which took place at prices which were probably much more higher than what had been envisaged. So it's going to be a function of how efficiently various corporates bid for these coal linkage auctions. So that is going to be the key issue. But more than that, I think things are, as far as coal is concerned, the challenge is a lot about evacuation abilities, and that's where the major challenge today is, rather than the coal mining itself. So I think that is where all the ministries will have to work in tandem to ensure that finally the coal reaches the end user.
Speaking about, the government, there was a lot of hope trade, there was a big hope trade and a hope rally which took place exactly 1 year ago when money went into the capital goods space, over and above, your traditional defenses like IT as well as, the pharmaceutical sector. In the last few months, we've seen, some, not pessimism which has kicked in, but, investors seem to be a bit disillusioned with India's rapid growth reform story. What are your thoughts on the capital goods sector, and how do you think these, frontline capital goods stocks will do in the next 1 year?
See, as far as the capex cycle itself is concerned, we have not seen any major capex being announced by the large corporates. So the corporates have still not started their investment cycle, and so that is where the challenge is as far as the cap good companies are concerned in terms of the order inflows. Initially the thought was that with an improved sentiment, business environment, etc., corporates would start the capex cycle. But I think corporates are still struggling with their stretched balance sheets, and they do not have the right debt equity balance to be able to start their capex cycle. So yes, cap goods have run up ahead of the curve, and the order inflow generally doesn't seem to be supportive of the valuations, and so you have seen some kind of a moderation in the valuations of some of the capital companies.
Okay, just one final question then to you, Mr. Karwa. You've written in your notes that one should avoid rural themes, and that's been the overarching story in the last couple of weeks and months, the slowdown that we've had in the rural markets. So what would you suggest avoiding? The two-wheeler names that are exposed there, or many of the FMCG names that have yet not shown any slowdown in the rural markets at least?
Yes, I think both. If there is a slowdown in the rural India, then obviously the segment that you referred to, which is the FMCG companies and also the two-wheelers, would see some slowdown in sales. But then most corporates are not only exposed to the rural India, but also to the urban India. So we are possibly seeing some uptick in the consumption cycle of urban India. But two-wheeler per se, yes, if rural India, if there is decent monsoons, etc., then there could be an uptick in the consumption pattern and demand uptick for the two-wheelers. As far as FMCG companies are concerned, they have also benefited from lower raw material prices. So I think overall, no doubt the volume growths have been more or less as per analyst expectations, but the threat of a slowdown from the rural India could be a reason to worry.
All right, Mr. Karwa, we'll leave it at that. Always a pleasure to get in your thoughts and perspective on the market. Thanks so much for joining in.